Let's say that you want to invest in the stock market and you are a beginner, you don't know how to approach investing in the stock market. What should you do? I will give you a very simple technique. Focus on free cash flow. Do not focus on net profit of the company, because the net profit of the company is an accounting number. It's not a real number. Look at companies that generate free cash flow. I discussed in one of my earlier videos is that there are three kinds of businesses: bad business, good business, and great business. Bad business is the business that cannot generate any free cash flow. A good business is a business that generates satisfactory return or free cash flow on invested capital, but is not able to reinvest that money back into the business because they don't have much growth opportunities. And the great business is the one that not only generates a free cash flow but is able to reinvest that free cash flow at the same rate of return that it earned on the initial invested capital. Apart from that, they are also able to give dividends to shareholders. So it's like icing on the cake. So, bad business, good business, great business. These are the three types of businesses, and I recommend that you invest only in the good businesses and great businesses. Ignore the bad businesses because there is no free cash flow there, there is no money left for shareholders. Now, I have been saying free cash flow here. What exactly is free cash flow? Because this is the secret to good stock picking. Okay, if you understand free cash flow, you can become a very good investor in the stock market. So, what is free cash flow? When you are looking at any company, the first thing that you should look at is what is the operating cash flow of the company for the past 10 years. So, every company has got a balance sheet, a profit and loss account, and the cash flow statement. Forget about the balance sheet and the profit and loss account. Directly go to the cash flow statement. There you will find a line item called as cash flow from operations. Let us call it operating cash flow. This is the money that the company is actually making. Okay, this is not free cash flow, but it's the money that companies are actually making by doing business. This, they have paid taxes, they have paid salaries, they have bought and sold goods, they have manufactured goods and sold those goods and services, and what is left over is the operating cash flow. It's less of everything. After doing business, whatever is left of is the operating cash flow. Now, what can the company do with the operating cash flow? First of all, they have to invest in capital expenditure. They have to maybe maintain the plant and machinery, or they may have to add more plant and machinery to grow the business. So, capital expenditure. From the operating cash flow, you deduct the capital expenditure. So, let's say the operating cash flow is 1000 crores. Out of 1000 crores, let's say you deduct a capital expenditure of 500 crores per year. Okay, so now you are left with 500 crore as your remaining amount. What do you do with the 500 crore? Let's say you have to pay interest expense because you borrowed some money. So let's say interest expense is 100 crore. So that's 500 crore minus 100 crore gone, you are left with 400. Out of 400, you deduct another 200 crore, let's say, because you also have to repay the debt, the principal amount. So you deduct another 200 crore. So out of 400, you deduct 200, so you are left with 200 crore. So out of an operating cash flow of 1000 crore, you are left with 200 crore as the free cash flow. So operating cash flow minus the capital expenditure, minus the interest expense, minus the debt repayment, whatever amount is left over, that 200 crore, that is the money that actually belongs to the shareholders. What can the company do with the money? They can either give it as a dividend to shareholders, or they can choose to use that money to buy back shares, or they can use that 200 crore to buy other businesses, right, which can increase revenue. Or they can do two of these. Like, for example, out of 200 crore, you take 100 crore and give it out as dividends, and you use the remaining 100 crore to buy back shares of the company. The company can do anything with the free cash flow because it's free cash flow. Now, not only do you look at the free cash flow, you also look at what is the invested capital. So let's say the invested capital in the business is 1000 crore. Okay, so the company is making 200 crore on 1000 crore. That's a 20% return on equity. When I say 1000 crore, I am only talking about the equity part. So the company is making a 20% return on equity in cash, because I'm not talking net profits here. I'm talking free cash flow here. So 20% return on capital, it's a great investment, right? Imagine if the company had taken that 1000 crore, and instead of investing that 1000 crore in this business, they would have put it in a fixed deposit in a bank in India. They would get, say, 5%, 6%, whatever. It's a very low rate of return. It's not even covering inflation. But since they have invested it in the business, on a 1000 crore, you are making 200 crore. That's a great rate of return on your money, and that's a good business. If the company does not have the opportunity to invest that 200 crore for future growth, that business becomes a great business if the company can take that 200 crore. Now you have 1000 already invested in the business plus additional 200. If company can invest that 1200 crore and earn another 20% on 1200 crore rather than 1000 crore, then that becomes a great business. Companies like Asian Paints and Nestle and all, these are great businesses, okay, because they have the ability to keep reinvesting whatever free cash flow that they are generating in the business. So this is the secret to good stock picking. First, you need to understand how to calculate free cash flow and why it is important. There are 100 ways to calculate free cash flow, but this is my way. I directly go to the cash flow statement. I look at the past 10 years of operating cash flow, I add it all up. After I add them, I add the past 10 years worth of capital expenditure. So if you look at a company like Castrol, let's say, they made like 6,000 crore operating cash flow in 10 years. Out of that 6,000 crore in 10 years, they spent 500 crore. So they made 5,500 crore actual cash in the business in less than 10 years. And since they don't have any debt, so there is no interest expense, there is no debt repayment. So actual 5,500 crore cash has been made by the company. It's a real company. It's not like some new age tech companies like Paytm and Zomato who can't even make a gross profit, right? So these are real companies who are making real cash money. This is the reason why Castrol has got around 1,300 crore cash sitting on the balance sheet. That's a real business to be looked at. Okay, that's a good business. I won't call it a great business. I would call it a good business because it is able to generate good return on equity. So that's the secret to stock picking. Understand free cash flow, compare it to the equity invested in the business, find out what is the return on invested capital, and then figure out whether it's a good business or a great business, and then pay a reasonable price to become a shareholder of that business. That is how you become a good stock picker in the market. So that's what I wanted to cover in this video. Hope you got value out of it. Thank you so much.